Righto money miners and righto miners that want money, because bloody MMS will make you money right now. Give them the open pit contract, do a JV with them. They'll bloody front the costs at the start. They'll take the cash later. Not all the costs, but a bit of it. They'll help you out. It's the deal of a lifetime. The best open pit mining contractor in the business.
The fleet will be there yesterday.
They take the risk and take it off you. It's bloody brilliant. Righto, boys, you've pulled an absolute rip snorter last week. This is a marathon of an episode for good reason, because of the quality.
Matty, I am very pumped to share this chat. Huw McKay is someone we've been trying to get on the podcast for quite some time. I think a lot of the money miners out there will know him for the work he did at BHP. They might not even know directly that it was the work he did through their sort of various strategies, commodity deep dives, thinking about steel markets and all these sorts of things. And the conversation well and truly lived up to my expectations. It is jam-packed with info. You know, you want to learn about where iron ore might be going, what's going to happen to copper, what the steel dynamics mean for the Aussie economy, all these things. They might sound far-fetched and all that, but he breaks it down super easily.
This is the guy that was at the forefront of the way that BHP, formulated and thought about its strategy around its commodities.
Wow.
And we got to kind of tap into that insight, and there's some perspectives here that you wouldn't know from just reading BHP stuff. He's a really thoughtful, independent thinker. He's really tuned into like the whole kind of China political angle and really what is happening there, what it means, how it might impact commodities. That was something that we got to tease out in a pretty lengthy episode. I'm excited.
Awesome.
I think with that said, let's rip to it.
Get ready to learn a huge amount with Huw McKay.
Alrighty, Huw McKay, thanks for making the time and coming on Money of Martin.
My pleasure. Thanks for the invitation.
We are super excited for this conversation for a number of reasons, and as we were sort of just discussing before we started filming, that the timing has been quite good given everything that's happened in China and global commodity markets. So the logical kind of place to start this conversation, I think, is around the stimulus that's just been announced in China, and perhaps digging into what you saw as expected versus unexpected coming out of the big announcements that we saw a week and a half ago now.
Yeah, no problem. Now, I want to put this in a little bit of context in terms of the history of the last couple of years before I dive into the package itself. Now, China has been enduring in a deflationary phase for most of this decade. It's getting up towards 3 or 4 years now that prices in China have been falling. Now, there's a good excuse for that in the first part of the period, which was the COVID shutdowns and everything that went with that. But there's no real excuse for the last 2 years if you consider what's been happening in the rest of the world, which is a cost of living crisis. So what's going on in China and how can the authorities fix that? Well, they have a very, very cautious, anxious household sector. That's the big one. How do they get jolted onto a path where they feel more confident deploying their savings into real estate, into equities, into discretionary consumption of both goods and services? That's really the ultimate question, which the authorities have to be looking at. Elsewhere in the system, they also have balance sheet problems, which have been piling up at the local government level principally. And they also have the housing market as a standalone proposition and real estate developers who have extraordinarily distressed balance sheets on their own behalf. So how do you come up with something as the Chinese authorities which hits all of those buttons successfully, gets the positive multipliers you look for out of any policy shift, but also fits in with the ideological framing of how the Chinese leadership currently see the world? It's very hard to design that policy. And China has been attempting to dollop out small spoons of stimulus, if you will, ever since the zero COVID policy came to an end, and there were even infrastructure stimulus while COVID was on. But nothing's really caught. And that's why household sector confidence is still low. The real estate market is still distressed. And we're just not getting the traction from counter-cyclical policies that you'd like to see. So once you get to this point, where your policies have underwhelmed and you just haven't got the outcomes that you're looking for, you get a little bit more urgent. I wouldn't say you panic, but certainly you start to question incrementalism as countercyclical policy, and you start to say, okay, what can I do which is more decisive? And the US Federal Reserve cutting interest rates, I think, took the People's Bank of China off the leash, so to speak, because of the wariness which the Chinese authorities have towards weakening their exchange rate. And so we've now got a monetary policy and macroprudential policy with respect to housing purchases, which is probably fit for the moment. You still need people to take up the offer, and that's really where we stand today. It's a very promising package in and of itself. What we know, we don't know exactly how much fiscal policy is going to come in behind, but that really needs to happen. And we're not going to know exactly what the Chinese household sector's response to the real estate story will be until state entities actually come in, borrow from the central bank, and accumulate property in their own name. So there's a lot in that. I'm modestly optimistic, but I wouldn't say I'm anything more than guarded, given how deep the confidence funk is and how dramatic a circuit break the economy actually requires.
You describe it as a need for a circuit breaker in a lot of respects, and because that incrementalism, maybe it's been ineffective. People like the households still don't have confidence. Property where a lot of people's wealth is tied, the prices continue to kind of decline there. But the circuit break is an interesting point because we've heard the policy kind of communication that's happened in the recent weeks described as a Draghi moment. We will do whatever it takes. Are you as extreme in your in the way that you would kind of draw parallels to a Draghi moment?
Okay, well, just for the benefit of your listeners who aren't as familiar with the corridors of power in Frankfurt, the Draghi moment was when the president of the European Central Bank, facing potential collapse of the common euro currency zone with massive balance sheet distress of the Greek, Italian, Portuguese, Spanish sovereigns, basically said, I'll do, as you said, literally whatever it takes. I don't think this is a Draghi moment in the same context. China isn't facing existential breakup. It's got a nasty cyclical circumstance, which is driving deflation, and it needs better counter-cyclical policy. So that's a challenging cyclical situation. It's not an existential end to a 60-year project of European political and monetary integration. So I wouldn't make them exactly the same. What I would say, and analogously, is that there are lessons to be learned from the two other circumstances where China found itself in pretty sticky situations. That was in the late 1990s into the earlier 2000s, where you had deeply embedded deflation across the system, and fully 50% of loans on the balance sheets of Chinese banks had gone bad. That's one analogy. And then what we dealt with 2013, 2014, 2015, where the hangover from the excessive stimulus of the global financial crisis era came into roost, and you actually needed to cut back capacity quite aggressively to restore any kind of sustainable fiscal trajectory for industries like coal mining, for industries like steel making, aluminium smelting, glass making, the list went on. And both of those circumstances received ultimately something dramatic, which enabled you to exit the regime that you'd entered. Now, you had three massive tailwinds that were starting to come through back in the early 2000s. That was the most profound problem, if you like, in terms of balance sheets. But the tailwinds that were coming down the line were, of course, much more favourable than what you'd expect today, and also much more favourable than what you'd expect in the mid-2010s. But resolving balance sheets, have the central government essentially carve out the bad assets from the banks, clean their balance sheets up, bring in foreign capital, enter the WTO, all of that stuff enabled you to grow out of the problem in the first instance. In the middle 2010s, there was an element of growing out of the problem, but equally there was a supply side adjustment, which actually downsized productive capacity to a point where it reinstated profitability. And that was very important for getting the heavy industries back on their feet. And that was tied in with the Belt and Road Initiative. And I think the Chinese authorities would look back on that with, then say it was a success on balance, even though not everything went right. This time around, we've still got a balance sheet problem, that's local government debt. And why I fixate a little bit on the fiscal side of what is going to happen, rather than the monetary side of what has already been announced, is that one of the big structural things which needs to shift in China is how vertical fiscal relations are organised. And what I mean by vertical fiscal relations is how the central government relates to lower levels of government, who raises revenue, who has the responsibilities to provide certain services, and how all of that balances out across the various levels. Australians are very familiar with vertical financial relations, West Australia in particular. West Australian government has extracted something pretty favourable from Canberra, and states that don't have the same sorts of revenue raising capability like Tasmania really feel the pinch of that. And that is an issue with vertical fiscal relations. It's very difficult to land on the most equitable relationship there. Well, in China, it's gone way too far in terms of the central government having preferential access to revenue, and most of the spending accountability is coming at a local level. And so the way things run there is a triangle. The local government runs up a deficit creatively. The central government is looking fine in a narrow sense. And then you have this huge flow of grants which have to flow from Beijing out to the provinces to make things roughly square up. But they never actually roughly square up. And that's where things like property price, revenue, off-balance sheet financing vehicles come in. And there's a lot of fancy footwork that keeps this thing spinning every year. You know, every 10 years or whatever the number is, you need to clean this stuff up because there's a lot of grey areas. And we need that right now. We need a very decisive intervention. Hopefully it means the central government steps up and assumes a lot of the liabilities that already exist. That's what I've called the sort of the do ex machina transfer, i.e. as in Greek drama when the god just sort of comes down from the ceiling and resolves the story. But you also need to resolve what actually happens in terms of tax collection and services allocation if you don't want to be right back here in 10 years' time. So there's two speeds, if you like, in terms of what kind of policy needs to be enacted there. And this is the other triangle you get back to, which is land sales, property developers, local governments. That particular triangle isn't working with the real estate market where it is, so it puts more and more pressure on the local level. And getting these things right at a simple fundamental level give you very positive multipliers through the system. The obverse of that, of course, is if you don't get them right, you keep getting further and further away from where you wish to be. And that's really what I think the powers that be in Beijing will be pondering, how they get this right so they're not right back where right back where they are today in 10 years' time. Because they tried to deal with this early in Xi's first term. They actually didn't take a lot of tough decisions at the local government level, even though they took them at the industrial level. And here we are again. It's there's sort of a rhythm to these things.
Yeah, don't envy that job at all. I'd love to learn more about the housing market, because I think there's so many tie-ins for commodities and Australia. So my understanding is that it was quite a deliberate decision a few years ago to try and move away the amount of wealth that was tied up by individual Chinese people in housing, and just diversify the economy in simple sort of terms. Is that understanding sort of right? And can you kind of elaborate on that journey that they've been on to sort of deleverage the housing market in China?
Okay, now I would say this is not about asset allocation for households in terms of how they spend their money and how they allocate their savings. What we've seen over the last 4 years or so, it is about deleveraging, but it's specifically about the property developers themselves, the organisations who build the houses. That was the balance sheet that they were focused on.
The Evergrandes, the Country Garden, sorry.
Country Garden.
I've been buying too many pants.
Yes, they're the names you read in Western media, but there are hundreds of developers. This is a massive industry, highly fragmented, very, very small market share for those big listed firms. And, if you look at the list of Chinese billionaires and the industry that they've been associated with, besides a couple of sort of tech platform companies, real estate tends to have dominated the list for the last 20 years or so. It's been a great way to get rich in China. Now, in terms of what the authorities have been doing going back a few years, they actually took the supply side reform template, which they had deployed successfully in coal mining and some of those other heavy industrial industries, and they actually dropped it down almost without modification into real estate. Now, completely inappropriate. Wrong policy for the wrong sector. So going back to what supply side reform ultimately did in terms of targets, it looked at the asset to liability ratios on a sectoral basis. It basically said, we want you to reduce your relative liabilities by 10 percentage points over a certain period of time. So for steel, it was about 60% asset to liability ratio. Sorry, it's the other way around, liability to asset ratio. And we want you to reduce that to 50. And that was quite successful because it basically forced the industry to stop thinking about expansion and to focus on profitability. In tandem with that, they came in with targets for how much capacity should be reduced, and which they've sort of brought a lot of illegal capacity sort of into the public spotlight. And so there were some hard levers to take capacity out of the system, but ultimately they were targeting a more sustainable financial balance sheet for the overall sector. Now, if you do that in a credit-hungry industry like real estate, then it's a train wreck waiting to happen, because real estate needs that constant flow of refinancing to keep spinning. And so when they came out and designed something called the three macroprudential red lines, which basically said, okay, there are basically three ways you can raise finance as a property developer. We're closing every loophole. That just is what gives you a sudden stop in building activity, because they even stop sort of the shorter term working capital inflows, which every construction operator would rely on. So they stopped activity, they stopped land purchases, and they sort of stopped new developments. So pretty abrupt. Did China build way too many houses in the latter part of the 2010s? Yes, of course they did. Incredible uplift in starts. Was this the right way of going about it? No, it wasn't. This is not a manufacturing sector. This is a sector where credit supply and refinancing are critical to the model. You can't just say you're going to invent some new model of running real estate. So it's been a real problem ever since. And a lot of property developers were caught out quickly, but even good property developers were caught out slowly. And that's just the nature of the industry when you stop the flow of credit. Now, have we fallen too far? Probably, in terms of absolute levels of development, but that will ultimately depend on the willingness of other sectors in the economy to move housing stock onto their balance sheet and off the balance sheet of the developers. And in 2015-16, whilst it was the administration's preference to not rely on investor purchases from out of town to clear the housing inventory overhang, ultimately they got pragmatic and said, okay, just do it. Because there was a mismatch on the demand and the supply side. There was a lot of luxury housing built in cities where there just wasn't the local income to support a whole lot of luxury housing. Who's going to buy that stuff? People from wealthier cities. But if you stop that flow, once again, you get no transactions. And that's bad news in an industry which constantly needs transactions to function. So you fast forward to today, sales are running at a higher level than starts, even though sales themselves are not looking particularly appealing. So ultimately, you are eating into that inventory overhang. And the absolute overhang that we have today is actually much smaller than what we had back in 15-16. What's different, I think, is that the backlog of prospective purchasers who would have bought a house if the controls were looser, I think that backlog was much bigger back in 15-16 versus where we are now. And this is where you get back to confidence again. How confident are Chinese households in A, the developer to deliver, and two, the asset price performance, which they're going to see out of real estate. And that's why you need the circuit breaker, going back to the first part of our conversation. And what's really novel about the policies we've seen this year versus previous cycles and also earlier in the cycle is this idea of state agencies or entities going on market and buying houses in their own right.
Well, you don't go on market and buy mining tenements in your own right. That's one thing I can tell you. You get MMTS to do it for you. I'd recommend everyone out there, do not try and mess with the winning formula that is McMahon Mining Title Services.
They are the go-to name in title service management across Australia, every single state.
Oh, they know more about mining tenements than the whole of China's population combined in intelligence.
True story. Shannon, he was quizzing his kids on the drive down south. Even them, it runs in their blood at this shop.
His
tenements.
kids were quizzing him.
That's it.
Because that's how much they know.
Yeah, what's that tenement? What's that one? These guys are all over it. No one else I'd rather have look after my tenements, Matty,
Exactly.
than MMTS.
No one would rather get me a tenement. You want to peg ground, you want to pinch a tenement off someone that's going to let it lapse, you get your bloody call lever and the team at MMTS. Get a hold of her and she's in the show notes. Details are there. Go for it.
It's amazing.
That's pretty quirky.
That's super. Yeah. You hear of central banks buying, government bonds, but you don't hear of, it's like buying up the housing supply is something pretty different. But the circuit breaker point, there's like it seemed like with the policies that kind of came out, okay, one is basically making it like inviting companies to buy back their own stock at these really low valuations, everything like that. It seemed like the measures were a big kind of turning point for the Chinese equities because you're indicating and signaling that this is a bottom. Buybacks are on their way. I'm going to make it really easy to conduct these buybacks. All these sort of quirks. Is that all an attempt to basically increase the confidence of the consumers themselves that business sentiment is changing?
I think it's an attempt to get what are currently immobile savings, if you're, they're just sitting on deposit in banks, actually getting them out into the real world.
Right.
And you can deploy that through the equity market. You can deploy it through real estate, hopefully both.
Why have Chinese residents historically deployed it in a much more outsized way towards the real estate market?
Okay, well, number one is that alternative asset classes just haven't been very attractive. And the two biggest stores of wealth have been bank deposits and housing. Real estate equity markets have never really performed in the same way that Western equity markets have. They're very politically driven and more so than economically driven. If you want to try and line up good things happening in the Chinese economy and what the share market has done, it's very, very difficult to correlate the two. It's really been driven by when the administration has sort of put some emphasis on the share market, that the share market has done well. It's not just a sort of broader function of economic activity and profits. Part of this is due to the mixed ownership of so many Chinese companies. It's also the way that companies treat shareholders in terms of the way they pay dividends, which is not much. And so it's more of a market which is based on small or short-term capital gains potential versus something which is actually going to provide you a flow of income over time. Now, real estate doesn't provide you a flow of income over time, but it is a store of value, and it's also an inflation hedge. Bank deposits are not an inflation hedge. This is also in the context of a Chinese household sector which doesn't have very good access to foreign asset markets. So households have never had the ability to fully deploy their capital into, say, US S&P 500 index trackers. That's all been very controlled. And so you end up with a lot of investable savings held domestically, and most of the international financial relations or international financial asset holdings have been either through foreign exchange reserves or through the major companies which accrue foreign currency assets through their operations. It wasn't that long ago that those foreign currency assets still had repatriation requirements and surrender requirements. So China is not that far into a reform of its capital account regime in terms of what you're allowed to buy and what you're not allowed to buy. Now, going back a bit in my career, when I was working for Westpac, we actually built a consumer sentiment survey for China. And this was modeled on Westpac's experience doing consumer sentiment in Australia and with the Melbourne Institute. So those of you who follow broader financial markets in Australia will be familiar with that particular release. And that in turn is modeled on the University of Michigan consumer sentiment in the United States. Now, I actually think the most important part of that survey when we built it up was actually the questions about savings. Why are you saving? And what do you think is the best place for your savings? And to understand the relatively low risk appetite of households in terms of where they put their money, you also have to understand why they are saving such extraordinary amounts out of their income versus a Western consumer. And the answer is the lack of a social safety net. You say, why are you saving? Most of the reasons were precautionary reasons. Things like putting a deposit down on a house were always very, very low, or to buy a car, or to go on a holiday. A lot of things that, Generation X, Generation Y, millennials in Australia will tick. That's not what people are ticking the box to do in China. It's saving against a potential health problem. It's saving against a period of potential unemployment. It's saving because my parents are getting old. It's saving to get my kids into the best school and to pay all the tuition fees. This is where that very sort of thrifty Chinese household financial model comes from. It's that you actually have to be self-reliant in so many things because the social safety net is not as developed as it is in the West. And part of that is due to the collapse of something called the iron rice bowl system of corporate welfare reform, which operated from the mid-90s and backwards. But when a lot of SOEs were restructured and privatised in the mid-1990s, that whole corporate welfare system fell away with it, and households had to become a lot more self-reliant.
Wow, that's really, really fascinating. To tie this in again with Australia, something we touched on when we spoke a little while ago is this plateau of crude steel production in China. And I know you've done plenty of work on this, Huw. So I'm keen to just get your broad sort of thoughts on this and where it kind of, what the trajectory is for this going forward and what we can kind of infer from the trends we've seen in the nearer term.
Yeah, okay. So the concept of the plateau of crude steel production in China, it's been around for a while. I would just put on the record here, though, that a lot of people who are calling peak steel now also called it 10 years ago. A lot of people who are calling the middle income trap for the economy now, they also called it 10 years ago.
Yeah.
Now, if they're right this time, they'll presumably be right for the wrong reasons because they got it wrong back in 13, 14. But every country's economic development journey has a pretty reliable footprint in terms of how much steel it needs at various levels of living standards. And if you picture this as a chart with the horizontal being the timeline and the vertical line being steel production per head, essentially it's an upside down U shape. And the peak of that upside down U is somewhere in the middle income phase of an economy's life. And that's roughly where China is. Now, why is it a plateau, not a peak for China? i.e., why is that upside down U shape, which in high school maths you remember is a parabola, why is it not a very discrete peak? And why is it a little bit level over the top there? Well, in China's situation, it's partly because its urbanization drive has not concluded. About 65% urbanized in China, and we'll get to at least 80, one would suspect. And so urbanization is one of the key underpinnings of the need for steel use. But also, China is much more internationally competitive in steel-intensive manufacturing than most other countries at this stage of their economic life cycle. And so even though we've seen the year of peak dwelling construction in China, the peak steel plateau has continued, partly because the steel has been diverted to manufacturing, where China is still internationally competitive. So I'm going to put this into some sort of simple ratios for you. At early stages of economic development and early stages of urbanization, construction plus infrastructure tend to be about 70% of use of steel inside a system and 30% for manufacturing. That's where India is today.
Mm-hmm.
Now, just before the pandemic, China was about 50-50. 50% for infrastructure plus construction and 50% for manufacturing. 10 years before that, it was more 55-45, 55 being the construction side. Today, much lower. It's more like 40-60, and actually probably even slightly lower than that, because real estate has been contracting and manufacturing's been rising, and so the relative shares are coming through. So China today is starting to look a lot more like the US, Japan, and Germany in terms of which industries are consuming the steel than it is like India. But this has all happened in a rush because real estate has come off so quickly, but also China has been rapidly increasing its global export market share in manufacturing. And that's enabled the steel production to hold up. And then there's where net exports are going. And net exports have been quite large, up to triple digits in terms of millions of tons over the last 18 months or so. And so that also feeds into the analysis. That number has been as low as 30-40 within sort of 3 or 4 years ago. And so that's still a swing factor. And so that's where we currently stand. We are going to go into demand erosion, I think, before too long. You may hold up above 1 billion tons next year, but by the skin of your teeth. And each year it's sort of, it's a chance that that's the year, probabilistically, when you do go below 1 billion tons of crude steel production, which is basically where you've been for 5-6 years. Is that a calamity? No, it's not a calamity. There's still a lot of life in Chinese steel-intensive manufacturing and in terms of Chinese urbanization. But the best days are in the rearview mirror. And when the historians come back, give or take data revisions, the peak steel year will have been 2020, which is the 1,065,000,000 tons. And we're probably not going back there. We almost got there last year on unofficial data, but we won't get there this year.
Huw, we might actually get there purely based on this bloody Sandvik ground support division growing at absolute speed of sound rates, like in talking about steel production this year. I don't know if he's put the Sandvik ground support division in his models for global steel production, but I think it needs to be considered, and I have mentioned it before, between the split sets, the PosiMix bolts, the MDX bolts, the mesh of all strengths, the mesh of all variation and sizes, mate. Chuck it in the model. Consider it.
In the, like tail end of the 2010s or whatever, it was the resurgence of China that lifted up the iron ore commodity markets, mate. This time it's going to be
it's the
surgence
of, there's no resurgence. It's just the surgence of Sandvik ground support division.
Binds are getting deeper. You need them to be safer. So then put these DSI bolts and mesh in.
Yep, you got to just...
Sandvik ground support.
Oh, we still got a bit of DSI in this, but it is Sandvik. Forget. Just Sandvik the shit out of your mind. Just get it into you.
That's
right,
it.
Chuck a Sandvik order in while you're there. Sounds as good.
And if my policy prescription of supply side reform Mark II were to be followed, well, that would take capacity out. So the Chinese industry would produce less steel and become more profitable thereby. And I think that's a better policy for the long term than overproducing steel, putting more pressure on international traded markets, keeping profitability low. Certainly, if I was running Chinese industrial policy, that's what I would be doing.
It's a nervous thought for the major iron ore miners out of here in Australia. If Chinese policymakers were to adopt some supply side measures similar to that 2014 period.
Yeah, it depends. You know, it's put a lot of pressure on the competitors of the major suppliers of the Chinese market as well.
For sure.
And when Chinese steel mills aren't making any money, high quality ores don't get rewarded in terms of the value in use calculus, which drives the trading of different products. And low quality products don't get penalized as much. But you do get a lot more differentiation between companies when steel mills are profitable and they're seeking to boost the productivity of their operations because they're making cash. That's when they start to pay up for low gang iron ores. And that's when they start to discount heavily for the lower grade stuff. And that's when they start to pay up the lump. And so this actually brings some differentiation, which actually is positive for the strongest iron ore producers. It's usually challenging for the juniors, and it's challenging for swing exporters. But in this regard, probably my main sort of analytical go-to thinking about the development of the iron ore industry is some analysis I did a couple of years ago when a group of analysts were coming through West Australia and iron ore to look at those operations. And if you go back to late 2018, just before the Brazilian producer Vale had their terrible accident with the Brumadinho tailings dam, the way people thought that market was going to evolve had sort of 5 stylized elements to it. No one thought demand was going anywhere. Everyone thought the major producers were going to increase their production. Everyone thought the cost curve was going to flatten. Everyone thought the smaller producers were going to be squeezed out. And everyone thought the price was going to fall. Pretty bleak, right?
Totally.
That was consensus. So the people who wanted to position themselves as extra bearish, had to really amplify that narrative. But the consensus itself was not optimistic. Now, from my perspective, I agreed with all of those things except the demand side. I thought the demand was going to be much stronger than people thought. If you fast forward 5 years to 2023, so the last calendar year for which we have complete data, demand was more than 100 million tonnes higher. But what didn't happen was you didn't get increasing tonnes from low-cost producers. So you didn't squeeze out the little guys, the high cost, the lower grade. So the cost curve didn't flatten. In fact, it steepened. And instead of a cost support regime, which was operating around $60 in 2018, you wake up in 2023 and your cost support has gone to a range from $80 to $100. And throughout 23 and the early parts of 24, the way that range operated is 100 actually was almost binding on the price because of how quickly some of those swing exports came out of the market when 100 was breached in a CFR basis. So the market didn't expect to be where it got to in 2023. Were the iron ore majors quaking in their boots at the outlook we saw in 2018? Well, no, not really. What was your no-regret strategy there? It was tilt to quality and be as efficient as possible. Pretty simple stuff. Mining is quite simple when you boil it down. Have an efficient operation in the first quartile of the cost curve and devil take the hindmost. That's really bulk mining, and that's why the best Australian miners are so successful in that market, because they can prosper at prices well below those that we've seen in the last couple of years. And in the fullness of time, we are going to see prices much below that range. Right now, like in the next 6 weeks, well, probably not. The 80 to 100 CFR range is still binding on the industry. And I think some of the commentary you see in the media in terms of the magnitude of shifts in this market, it's a little alarmist because when you go from $110 to 100, so you got a 10% move. Well, the average volatility of the iron ore price is above 40% annually. So 10 is just white noise from week to week. And that isn't something that would be seen as material inside a company in terms of budgeting and the like, because we understand what the volatility of these commodities are. You can't treat commodity price volatility the same way you treat share price volatility or currency volatility or bond market volatility, because they just have completely different characteristics in terms of transaction density, intra-year seasonality and the like. And so, if we go from 100 to 85 over the next few months, yes, 15%, but it's still well within the boundaries of regular volatility in these markets. What is the more useful sort of analysis is running a lot of scenarios to actually think about when you hit those key pressure points in a market, when you go from one shelf on a cost curve to another shelf. Now, that could be downwards, but as the 2018 to 2023 episode told us, sometimes you actually end up on a shelf you didn't expect to be on, which is the higher shelf. And that was a tremendous sweet spot for the Australian mining industry, not least because the Australian dollar didn't actually follow commodity prices through that period. So you got a double kicker. The US dollar commodity price went up and the US dollar costs were actually being favoured by a lower exchange rate. And I don't think everyone has sort of quite twigged to how powerful that disconnect between commodity prices and the exchange rate was for the Australian dollar profitability that actually funds the federal treasury. And one of the questions I'm looking at the moment is, how does that disconnect ultimately resolve?
I'm really curious, Huw. You talk about going from one step on the cost curve to another one. I mean, like some of the bearish commentary you hear about the iron ore market is all to do with the supply side, where people love to talk about the Simandou supply coming online. Vale's kind of increasing their production back up, and then throw in the mix sort of the likes of MinRes going from aiming to go from 0 to 50 million tonnes per annum, kind of out of Onslow in a shortish period of time. So then you've got the higher cost producers sort of ramping in an environment where you've got lower cost production also coming on, and as you describe it, a potential kind of demand plateau in some regards as well. Is that enough to knock us from one peg on the cost curve to another?
Oh, look, anyone in the high cost bracket, I don't think has a compelling case to be financed right now.
It's a diplomatic way to put it.
That would be one way I think about it. But look, if you haven't had Simandou in your numbers for about 6 years, that's just poor analysis, I think. So everyone should have been planning both tactically and strategically for the entry of Simandou and seeing how everything looked strategically on that basis. Now, the only real debate there is A, timing of first tonnes, and B, ramp-up schedule. Actually, there is a third one. It's ultimate nameplate. And that's something I think people are still looking at in terms of the ability to transship versus the ability to dredge a port, and whether that's physically feasible or financially feasible, etc. But for the period between now and 2030, we know we're going to get first tonnes, and we know we're going to face a ramp up. Well, yeah, that will displace tonnes that are currently in the market. Absolutely. Will it displace enough tonnes to get you out of this price regime? In some scenarios, no. In some scenarios, yes. And that's where you have to look at this on a probabilistic basis and a scenario basis. It will depend on the demand side, as you say, but also the ability of those producers who are currently providing the cost support in the market. And I should just say there's roughly 180 million tonnes in the cost support bracket at the moment. It's not trivial. How will they respond? And also some other things like in terms of how we go with profitability and value and use differentials, as well as freight rates, to actually see how things move around. Because Simandou tonnes coming into East Asia obviously are at a freight disadvantage. And it also depend on how well the Brazilians go in terms of increasing production there, particularly Vale. So there's still a lot of permutations. And if you look at the numbers, the tonnages, which people generally ascribe to Simandou, and the 180 million tonnes that I've told you is unexpected supply, which is in the market to keep it balanced today, which basically describes this new shelf. The Simandou numbers are smaller than the tonnes that are in the shelf. Now, so that's why you need other things to happen. You need a relatively complex scenario and not just a binary one to think about how Simandou will influence the market.
What are the sort of key takeaways or lessons like you would give someone just trying to understand how to forecast commodity prices? You know, we talk about it all the time. It's notoriously hard, and you've studied these markets for years and years and years. Does it always just come back to the cost curve and understanding supply and demand, or are there sort of left field, points of view, not really focusing on the shorter term commodity prices because that's just so challenging, but if you're looking at medium to longer term forecasts, is it just getting your hands on better data, understanding it better, or what do you kind of ascribe better forecasting analysis to?
Well, look, there's a lot that goes into it, as you say, and there's a lot of different methodologies which exist. Now, I think most mining companies pride themselves on doing what is called bottom-up forecasting, i.e. they actually try and assemble as much as they can from the bottom in terms of making assumptions about individual companies, so on and so forth, to get them to their final answer. And that's got a lot of validity because you know that once you've made all your bottom-up assumptions, that will add up to the answer. The problem is you have to make far too many decisions along the way to do a bottom-up forecast. And there's only so much fact that you can feed into a model as you start to roll it forward. So what do I think the industry currently does quite well, and what do I think the industry does quite poorly? I think on the demand side, I don't think the industry in general has very sophisticated methodologies for going from the short to the medium to the long term. That's number one. On the supply side, I think far too little effort goes into deeply understanding the cost base and how the cost base is influenced by cycles to actually run through what the long run cost curve is genuinely going to look like. That's a really big issue. And I think it's most pronounced at the bottom of the cycle and at the top of the cycle in terms of industry costs. So my suspicion is that long-term costs are probably being overestimated at the moment because the starting point is so high. Mm-hmm. And I know for a fact that long-run costs were underestimated when we're at the bottom of the commodity price cycle.
Is the intuition here, Huw, just that like when prices are elevated, we're a bit less efficient. We put more through the mill if it's, well, I'm not talking iron ore here necessarily, but there's a bit more fat to things, and it's in the troughs where we get more cost efficiencies out of it because we run things way leaner and we're much more conscious about oversupplying the market in those times too.
Oh, well, yeah, there's a pro-cyclicality to decision-making. That's what you've just described. I think there's a pro-cyclicality to decision-making that you need to understand, the psychology of the lay person. And the people who run mining companies in some instances are lay people in the sense that they're an accountant or they're an engineer or they're a business development person. And suddenly they find themselves trying to deal with 30-year megatrends. So you have to recognize that pro-cyclicality will be there. Then it interacts with something called recency bias. You have pro-cyclicality because you're recency biased. And I think really good long-term forecasting requires both courage and imagination. Courage in the sense that you have to be willing to countenance very, very large changes occurring within the forecast period. And imagination to actually think through what those really, really big changes could be. Now, there's an anchoring effect where people don't want to produce things which are difficult to explain or might be controversial. And that often means very timid long-term forecasts where not much actually changes. But that is exactly where you bake in the conditions of the day for too long, even though this industry has massive amplitude. So 40% in your average year, that's different to the peak to trough for the cycle. And there's another point here where I saw this is really pronounced on the cost side. Like I remember in the middle of the pandemic when oil demand sort of halved overnight and you just had this enormous crunch on the upstream supply chain. One of the best consultants in that particular industry released a new long-term forecast of deep water capital costs. And basically what they'd done, once you sort of stripped it back, is they'd gone to this new trough to the pandemic, and then they'd applied exactly the same CAGR that they had previously before the shock to the new starting point. So you know what that looks like in terms of a long-run forecast? It's two lines parallel to each other with very, very different starting points. So you're not saying anything controversial about the rate of change at any given time, but you're miles apart at the end point. So I call that a windscreen wiper forecast because you go, you just, the end of the windscreen wiper is just flicking around like you wouldn't believe because the rate of change in any given year hasn't really been altered. And that's where the short term and the long term just don't talk to each other. And you have to recognize that and have different methodologies for looking at them. Now, one final thing about commodity price forecasting is that commodity price formation is much more prone to non-linear jumps than economy-wide inflation. That's because supply and demand are both more fragile. In macroeconomics, when they're trying to forecast the CPI, they basically assume that the aggregate supply curve is just a straight line. Whereas if you compare that to the cost curve in mining, it's not a straight line. It often has this very steep tail, sort of between the 90th and say 105th percentile on the curve. And small permutations one way or the other can give you very, very big changes in the price. And one of the reasons why central banks completely misread the pandemic is that the aggregate system was under such distress that there was you'd actually got to a situation where aggregate supply had a kink in it or a new shelf, as we've discussed earlier in terms of the supply curve. But if your main world is commodities, you're thinking about these shifting from one shelf to the other all the time, and you're thinking about non-linearities and kinks in supply curves all the time because it's just a way of life. And actually forecasting aggregate economy-wide inflation, which is something everyone should do as they try and understand the cost side of their balance sheet as a miner, was actually an advantage coming from a world where non-linear pricing was a very real thing. And where do I think non-linear pricing is going to come next in the positive sense for miners? Well, it's absolutely coming in copper. And you can look at these markets and you can identify thresholds where the price is just going to go vertical. I think one of those moments is coming in copper before the end of the decade, because historically you can identify when the stock level gets so thin that you are going to get into a threat of a stock out, which becomes self-fulfilling, and you get a vertical price development. The freight market is another one where these thresholds are very real. But copper is the one, because of how actively traded it is by hedge funds globally. There's a lot of speculative money that's just finding its way into that industry. It's got the energy transition tailwinds. It's got the supply headwinds. It's all coming together for that market. And understanding those historical episodes, looking out for non-linearities rather than abstracting away from them, I think will help people make better decisions in that sort of 3 to 5 year window, which is sort of very underdone because the banks don't care. Banks are interested in the year they're in and maybe the one after. Everyone budgets for year one and maybe year two. That 3 to 5 year window, a lot of stuff has to happen in that window, but it's almost unoccupied in terms of forecasting effort.
So how do you think about a company taking advantage of that then? Because there's not too many that really can. You kind of have to be at the bigger end where you've got a bit of, financing capability. If you're just an individual, junior here in Perth trying to get a copper mine.
And the copper projects that you can buy are priced like that. You have to pay 10 times EBITDA for producing copper mine.
Yeah. So, how do you kind of think about that in greater detail? How do you think about a supply response, I guess, in terms of timing it would take? Because it's an issue we talk about all the time, just how long it takes to get these things online. I'm just keen to go a lot deeper on the copper point.
Yeah, well, look, one of the things that you can do, now maybe this isn't as applicable to a junior, and I've never worked in a junior and have no plans to, so I can really just speculate on these points.
Go for it.
Look, if you are in any way in the game of acquiring your competitors, then not so much looking for the discontinuity up, the discontinuity down, and planning for that and getting all your ducks in a row, waiting for the best buying circumstances you're likely to get in a particular decade is a pretty good way of running your operation. And certainly there was a moment that we'd identified would be a pretty decent time to go out and look at copper, acknowledging your point that copper is generally expensive. You may not get many good times to transact, and therefore planning ahead for when the dips are going to come, because even if you're a superstar with a halo effect like copper, you're not aloof to the economic cycle. So there will be times when you can transact. As someone running a very lean operation and trying to create value in a junior, Look, one of the places I think that mining companies don't spend enough time, mainly because it's not glamorous, but huge value is at stake, is actually the procurement side of their businesses. There's enormous value to be gleaned from being smarter at procuring than your competitors, which ultimately means being at least as smart in their area of expertise as the person you're procuring from. And so I'd really encourage any company to invest as much effort in trying to predict what's going to happen to the stuff that they buy as a mining company as the stuff that they're going to sell as a mining company. And if you're a junior who's in it to win it in whichever commodity you happen to have a prospect in, you don't have to worry too much about the price of it because you can't do anything about it. But you can worry a lot about all the stuff that you procure, and doing a little bit better there and being able to be counter-cyclical on your procurement can actually create a much more resilient company in the long run, and not one which is going to be going to have an uneconomic cost base when prices turn. Start building a resilient economy from a resilient company from day one, I think would be the answer. And that might be doing something unconventional. Instead of studying the price of what you want to sell, look at the other side of the balance sheet.
Huw, I'd love to know as well. I know your time at BHP was probably focused largely on, to the extent you looked specifically at the commodities, the commodities that they play in, and maybe a fair bit of work on the rationale and everything like that. When I remember hearing Mike Henry speak about why BHP didn't play in lithium, and it was to do with a view that in the long run the cost curve wouldn't be steep enough to warrant that. Are there any other commodities other than the ones BHP is playing in today, like maybe even more niche ones, where you actually are kind of interested that because you think there is potential for there to be kind of steep cost curves on a medium-term outlook?
Well, look, I think the way you've stylized the BHP position on lithium, certainly cost curve shape, current and projected, is a element of the attractiveness framework that BHP use, but it's certainly not the only element. I would suspect that the executive team at BHP are getting a few less questions about why we're not in lithium today than perhaps we might have got 3 or 4 years ago. But this is a cyclical industry. It's got a stunning demand side trajectory, as does nickel, as does any battery commodity, as does any energy transition leverage mineral. But yeah, it comes back to all the other things. So no, I'm not going to throw a new commodity at you today. Are there some things which I think are quite interesting and offer some more differentiated leverage to the world we are potentially moving into? Yeah, I do. But I don't think I'm going to throw them out there today. What I would say is that for a big company like BHP, it's got to be a big enough value chain for you to want to play in. And whenever you put the niche in front of something, you probably have answered your own question by saying, what's your interest level? However, the most attractive assets in the mining industry often have a very favourable byproduct / co-product revenue stream to go with the core commodity. And if you happen to have something with a commodity you're interested in and the value chain is big enough, and you potentially got something interesting on the niche mineral side, it probably makes the other prospect a lot more interesting. But that's probably the way to think about those smaller markets from the point of view of really big market cap organizations. Because you having a standalone business that is substantial enough for a big market cap miner, the share of that actual market you would require is probably prohibitive in terms of what a competition authority would look at and say is sensible. So you can't say, oh, I want to be in commodity X, but to hit my size threshold, I need to have 60% of the tons. Well, that's not going to work really. And so you run into some logistical constraints there as well.
Something we again see with sort of smaller to medium-sized businesses in exactly what you said there, going after projects with byproducts, is that they ultimately stream out the byproduct in order to help finance the thing. Again, not something you might see with the real majors around the world. But is your gut feel toward that's a somewhat bad decision in a sense, and that you should be attracted to the two minerals and not forego the potential benefits by streaming it out to help bring the operation online?
Well, I think the answer is you've got to do what you've got to do at the time. Now, if you go back over the history of decision making, when companies go into joint venture arrangements because they're looking to share risk on something that they're not absolutely certain on, they often end up as regret decisions. Because if it ends up being a good idea, you then begrudge whatever share of the asset that you sold, obviously too cheaply at the beginning. But that's the quandary of resources industry investments, and it goes for petroleum just as much as it goes for the mineral sector. And it's particularly pertinent when you're going into new jurisdictions as well. So with a new jurisdiction, you're not just looking at the asset, you're looking at the operating environment, you're looking at the above ground risk, in addition to the below ground risk. And you're also basically taking a call on the governance and at what point am I actually going to be able to assume regime stability in terms of the fiscal obligations and the like. And under those circumstances, risk sharing with joint venture partners is very, very common. But you can never actually devise the right shares of the pie. So let me just give you a hypothetical example. If a new mineral jurisdiction is opening itself up under a new market-friendly regime, having been with a regime which just isn't that friendly, they still need to get some runs on the board to bring the foreign investors in. So they will need to offer big discounts on the fiscal regime to get anyone to come in to defray the risk that they're dealing with. But if they turn out to be market friendly, not just in the short term, but also in the medium term, the company that has come in is going to be enjoying incredibly attractive returns because of that upfront discount. At which point the host jurisdiction says this is not fair. We've been really well behaved, but you've got this great deal. And the community then gets involved and says, this is unfair. We've been taken for a ride by this slick international operation. We need to renegotiate. And before you know it, it's almost like a conflicted virtue in terms of the regime. They end up becoming expropriatory because they weren't expropriatory, but because the regime before them was. And you just get yourself in this interesting sort of phase. And Chile used to be like that.
Yeah.
And lot of those tax stability agreements are going to expire in the 2020s. And so as we think about all the potential operations that could come out of the copper belts with new infrastructure and that sort of thing, it's still the kind of thing you have to bounce around in your head in terms of where you end up going. Now, I know your question was about streaming out byproduct credits, but I think there's an element of, what does a young mining company have to think about at the outset? And ideally, you retain as much control as you can, and you finance sort of on a de minimis basis. But the reality is you can get unlucky if you have to refinance at just the wrong time. And that even happens to big companies. And so you kind of end up trying to overfinance. You end up trying to over-insure the future of the project. And one of the things you do is you can stream revenue. But if it ends up being as good a project as you think it is at the outset, generally they're regret decisions, but they're not necessarily things that the company had the discretion to look past at the time. And you have to qualify any sort of into the future critique by the realities of the moment when that decision might have been made.
Huw, if you were to point to one thing that consensus or the general public or mass media kind of gets wrong en masse in relation to the interplay of China and commodity markets, what would it be?
Well, I'd say one thing I've always scratched my head about is why people pay much attention to monthly trade data into China in the bulk commodities. Because basically the imports into China on a monthly basis are sort of a function of what was happening a couple of weeks ago in Western Australia and 6 weeks before that in Brazil. It's actually more of a short-term measure of supply than it is a measure of demand. But I think because economists are so used to looking at trade data from statistical agencies rather than sort of bespoke consultancies who measure what actually matters in commodity markets, they kind of make a big deal of the monthly trade figures in China. I don't think the monthly trade figures are a big deal. If you're actually looking at these markets in the short term, you're getting much better data than that on, at worst, a weekly basis. And you can track these markets without any reference at all to official customs data. And by the time that data is available, I think insiders in the industry have moved on. So I think I wouldn't emphasize them too much.
I just think you have like a pretty fascinating view. I mean, kind of given the extent you really looked at the interplay of everything, and no matter who you speak to who's done a lot of work in China, they're quick to tell you that everyone else's view is wrong.
Oh, look, when I first started looking at China 20 plus years ago, I think it really was something where there was a handful of experts and then everybody else. People have sort of had 20 years to get their heads around a few things with respect to China. And so I think that there's more people who will say sensible and similar things, even though they haven't, done their PhDs on the Chinese economy. So I think it's probably better now than it used to be. But one thing that people, I think, do miss a little bit is trying to use the equity market as a proxy for how the economy is performing. that's not even a mistake. That's just ignorance. But you do sometimes still get that. But that's because analysts are entering the market all the time, and quite often people don't know what they don't know, and they will try to use whatever framework they've developed in their short time in the industry, and they have to sort of make those mistakes before they work out what they don't know. So the link between the economy and the equity market is useful. I do find that the UK media is quite biased against China. This is the general confirmation bias that they will leap on any bad news and find a bad news undertone to any good news. But that's also a bit like the fact that everyone called the end of the era back in 13, 14, 15, and it wasn't the end of the year. It was yet another cyclical phase where an economy struggled for a while, as opposed to making very bold pronouncements about that's the end. So I do sometimes find that there's some weaker stuff there in terms of the editorial overlay on China can be just quite pessimistic as a general sense.
How much stock do you put in the sort of friendshoring, reshoring, whatever you might call it, phenomena that we've started to see and hear, a lot of since COVID? Is this something that seriously, alters the growth that the Chinese economy might have had, and how does this kind of play into inflation around the world in your view?
Oh, look, if it occurs as per political rhetoric, yes, it's definitely inflationary for the world. Deflationary for China, though, because that would give China even more excess capacity. One thing we should be aware of, though, China's also trying to de-risk from the rest of the world. So if China decides to do something as a national economic priority, they tend to get it done a little bit quicker than other countries.
I have noticed that.
So it's
a lot quicker, I've noticed.
So that's the challenge in this context. If you look at where the growth in the copper industry is coming from at the moment, well, it's Chinese firms working in Africa because they can see a serious problem here in the way this demand-supply balance in this core commodity is evolving. And they could sit there and wring their hands about it, or they could overpay for some copper prospects and get going. And so there is going to be an attempt by China to de-risk and onshore as well, particularly in technology. So onshoring, offshoring, etc. It's very big in the semiconductor manufacturing space, and Australia is only sort of obliquely related to that value chain. And so we don't really get a sense of that. I mean, it'd be easy to sit here in Australia and say this is all talk, but there's a lot of stuff going on in semiconductors. China's trying to de-risk. The US is putting huge subsidies under its CHIPS Act. And, there's steel on the ground there in terms of new projects into the US. Europe is also attempting to act. Japan is acting. Korea is acting. That is probably one of the more fragmented supply chains in the global system in terms of the value chains that it's serviced, but it's actually becoming more localized again, and that is probably the place where it's becoming a little more pronounced. But you still have incredible focal points like TSMC, who are still irreplaceable as the core contract manufacturer. You still have, a Dutch firm, ADSL, I forget the exact acronym, which has a particular bespoke piece of equipment to actually manufacture that is still a critical point of failure in the supply chain. And so it's a long way from fruition, but the intent and early actions are definitely there. In more generic manufacturing, you have seen a major increase in trade flows into the US through Mexico, through Southeast Asia, which is clearly displacing Chinese trade. But this is not onshoring as such. It's more about redirecting, and I'd call that de-risking rather than decoupling. And if you peel the numbers back a little bit, you'll actually find that there's a lot of round tripping involved as well. Round tripping being where you produce something somewhere, you send it somewhere else, get some kind of origin certificate, and then you on-send it. So you can go China, Southeast Asia, Mexico, US. And you're also seeing China start to invest a little bit behind tariff walls. If you go back to the period before Bretton Woods broke down in the early 1970s, so between, say, 1971 and the end of World War II, the global system that we inherited from the interwar period came with very, very high rates of protection. It also had very, very high rates of income tax because of the way governments skew the savings superstructure inside a society when they go to war. And capital controls were very pronounced. So there wasn't a lot of portfolio flow. No global hedge funds in 1946. And so it was a different world. It was a clunkier world in a sense. But at that stage, there was still a lot of international investment. But it was from America basically exporting their manufacturing behind tariff walls by building things like General Motors Holden in Australia, or going to Europe and building Opel in Germany. And it was this outward foreign direct investment to go behind the protection, which was a key driver of globalization in that period. It was very different to the globalization we think of, which was more about labor arbitrage. The globalization in those days was about jumping the tariff wall. It took a long time to move through that style of globalization to the labor arbitrage style of globalization that also comes with a lot of hot money flowing around the place and floating exchange rates, because exchange rates were fixed back then too. Mm-hmm. And it was a much more regulated world. And it sort of took the shock of the 1970s to tilt the world onto a different path. And then we sort of entered into the deregulation of finance, hyperglobalization, Washington consensus world, which is now fracturing. And, we used to get trade liberalization in those days too, because the World Trade Organization and its predecessor actually did some really good stuff between 1950 and, say, 1990-ish. It's just kind of fallen into disuse now. So, yes, it's inflationary if it happens. Is it happening everywhere? No. Is it happening in some places? Yes. But East and West are both attempting it. Don't think the West is doing it alone. And if China does do this aggressively, it could happen quicker than we think.
Huw, I've got a couple thoughts that's just sort of come to mind as you mentioned the dollar gold kind of system. A lot of people in our neck of the woods had made a lot of the central bank buying of gold following the events that transpired between Russia and Ukraine and other sort of geopolitical conflicts. On the China point, it's sort of been put on ice a bit for the last few months, the central bank buying of gold. But is that something you've studied at all, spent much time looking into or thinking about?
Yeah, I think the ramifications of the way Russia has been treated will will run for a very, very long time. And shutting Russia out of SWIFT and seizing their reserves, which are essentially held in custody for them in various global central banks, was a very, very aggressive thing to do. Now, very risky thing to do as well. So I do feel that has contributed to the move towards gold, but it's still very much at the margin. You actually think which central banks hold the most gold around the world? It's actually central banks who issue a reserve currency at home, the Fed and the ECB. If you've already got a reserve currency, why would you bother holding another reserve currency? Hold some gold. So yeah, it's a moderate factor. I think gold is hard to talk about from a forecasting point of view, partly because it's a chameleon in that what drives the gold price changes depending on what sort of macro financial regime you happen to find yourself in. So sometimes it can serve as an inflation hedge. Sometimes it just trades in line with the broader commodity complex. Sometimes it can trade as the obverse of US Federal Reserve policy. And you have to basically identify which regime you're in and then do your gold price forecast. You can't just do it in isolation. What's going to be interesting, I guess, is if you look at the marginal cost of extracting gold, it doesn't start with a 2, which is where the spot price starts. And so whether or not the extraction cost of gold will ever be a binding criteria for the gold price, or is gold just doing what Bitcoin claimed it was going to do, which is question the hierarchy, which puts fiat currencies at the top of the global international financial architecture. I'm just being a bit silly about that. I'm with the JP Morgan CEO on that. I think cryptocurrencies are pet rocks, but doesn't mean other people don't make money off them. They certainly don't advise my mother to put her pension in them. So yeah, gold presumably, if all people care about is the Fed and lower US interest rates, then generally that's a gold positive circumstance. But at what point do central banks get to the point where they're comfortable with their gold holding? Because they're not going to be perpetual flow purchasers. This is the thing. Let me sort of tell you how central banks think about reserve management. They will make a strategic decision internally after extraordinarily detailed and sophisticated deliberations, and they would have made a choice to increase their allocation to gold. They will be price insensitive purchasers until they hit whatever allocation they decided upon, and then they will stop.
The gold producers don't stop
is.
producing at that point. They keep producing.
Yeah, so that's basically how it works. The other thing about foreign exchange reserves, and this is truly something that I think is not understood by many, foreign exchange reserves are basically a residual of a country's balance of payments. So once all of the inflows associated with export or credits and all of the outflows come through the financial shadow of that in terms of lending and portfolio activity, errors and omissions, which often means sort of illicit flow, which they don't want the tax authorities to see. It's a final number, which is the change in reserves. So this is basically whether or not more money came in or more money left in the period. And ultimately, that is your FX reserve position as a country. And that accumulates into a stock of reserves. Now, I often read something like, China sold $100 million worth of US dollar securities last year or something, just picking a number out of the air. You go back and you say, okay, how much did Chinese foreign exchange reserves change in that period? Well, let's say it changed 200 million in the same direction. It means part of that change meant that assets the country held, they no longer hold. How discretionary is the decision to sell treasuries versus do something else? Yes, at the margin. But ultimately, the treasuries are held in something. They have flows which are happening continuously. And arguably, the most passive thing that could have happened is that the treasury position ran down. If it goes up 100 because reserves went up 150, well, that's also sort of a passive response to the fact that sort of just as a residual outcome of what occurred in the period. It's only when a country is systematically intervening in its foreign exchange markets that it will accrue or run down reserves through choice. And there aren't that many major economies where that occurs anymore. So it's a very misunderstood thing and generally badly reported.
I got one more question for you, Huw. You recently wrote that letting the Chinese Yuan find its own level would also kind of help the current situation in China. How likely would this actually be, kind of given the competing priorities of Chinese policy setters?
Well, yeah, I think part of the answer here is the fact that the People's Bank of China came with their policy package after the US Federal Reserve lowered interest rates and not before. So that indicates that there's still at least half an eye on the exchange rate in terms of how the monetary policy is being run. So let me just explain sort of as quickly as I can sort of how this particular issue works. China has a managed exchange rate, not a fixed one, but a managed exchange rate. It doesn't want the volatility to be too great. And it also, in an attempt to simplify that task, it also controls flows of capital across the border. Letting the exchange rate find its own level essentially is foregoing either letting the capital flow more or the lower levels of volatility. But whilst you want to keep the low levels of volatility, you can't allow the relative interest rate differential with the currency you're measuring against to get too far out of whack. And while the US Federal Reserve has been running a high interest rate policy, that creates capital outflow pressure in China because there's better returns available in US dollars than in China because the interest rate level is set lower. If they had gone and lowered interest rates before the Fed had moved, they would have increased that backlog of depreciation pressure. But once the Fed actually gave them a license, if you will, to come up with that, that's when they delivered the package because they basically wanted the air cover to prevent there being too much pressure on capital outflow, which is something they don't want. And they certainly don't want what we would see as an unwieldy or uncontrolled depreciation, because we let the Australian dollar do that frequently. When things look bad in the global economy, the Australian dollar falls without a thought for its dignity. It falls fast. That would be not something that Chinese authorities want to see. And that's why I think they're somewhat locked in to the kind of policies that would not bring that lever fully to bear. Part of that is geopolitical as well. I don't know if you were in financial markets, sort of, when was it? Maybe 7 or 8 years ago. Overnight, they sort of announced that their currency would be 2% lower, and there was panic. 2% is, it's a big day for the Australian dollar, but, the next day people would just deal with it. It moved all global financial markets in the sense that China might actually devalue the exchange rate a lot. Now that the geopolitical rivalry is where it is, though, how nice will China continue to play on the exchange rate? How nice will China continue to play on its exports of steel? Chinese excess capacity, Chinese exchange rate depreciation could do considerable damage to the global system if they came with a rush. China doesn't want to do that for its own reasons. But at some point, perhaps relationships deteriorate and the exchange rate is sort of on the table, if you will. But right now, it'd be good policy, because when you've got deflation, it means your exchange rate is too strong. Your exchange rate should be weaker to get some inflation into the system. Beautiful,
Huw. I think we've taken more than enough of your time today, but massively appreciate you making yourself available and coming on the show and sharing your wisdom with us.
Okay, no problem. So thanks for the invitation.
Thank you very much, mate.
Good luck with the edits.
Thank you very much, Huw. We greatly appreciate it. That was wicked.
Awesome.
We learned heaps, and we're super appreciative of the generosity of your time.
Yeah, I learned a phenomenal amount. I'm keen to listen to back to that one already. So can't thank you enough.
All right, no problem.
Right, sensational work, lads. That was, I can't say I've listened to the full thing yet, but I'm so going to. There was good energy from the big fella.
It was cracking. And to all the money miners out there, we've taken a lot of your time this weekend. So we all hope you have a cracking rest of the weekend. And we'll say a big thank you to our partners as well.
MMS, Grounded, CrossBoundary Energy, Sandvik Ground Support Division, CRE Insurance, Greenlands Equipment, K-Drill, MMTS, Australian Earth Moving and Haulage, and get a spark chart up ya.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.